right, everyone, welcome to the latest season of the Sherman Show. I'm Jeff Sherman, here with my co-host Sam Lau.
Hey, hey.
And today we have a very special guest from across the pond. He's none other than Jim Reid. Jim, welcome to the Sherman Show.
It's a pleasure to be invited. Thank you very much.
Yeah, thanks, Jim. And so for those of you who don't know Jim Reid from Deutsche Bank, he's a managing director. He's the global head of fundamental credit strategy, and he also heads up Deutsche's Thematic research product and corporate bank research. So if you don't know Jim, what you really should know, he's a top break strategist. He's consistently named the #1 analyst in surveys over the last 25 years. He was most recently voted the #1 strategist in 4Ks in the European Institutional Investor poll. He's had 25 #1 position these awards. So I'm going to say he's a pretty good expert in the field of macroeconomics. So not only do you do a good job there, but also implementation and how to implement that from a strategist point of view. So Jim, cool. Welcome to the show.
Can we end the conversation there? I'm quite happy to leave it like that. That seemed a good intro.
And so everyone, thanks for listening. That's Jim Reid. As you heard, he's just a stud. He's a strategist. He's great. So, but Jim, I know you put out a daily publication now. It's called the Early Morning Read Report. I think it's very clever too. I like to read it each day, especially being here on the West Coast of the States. It comes about midnight or so. So it's the first thing I read in the morning. And what I noticed in looking at it is it said that you had over tens of thousands of daily readers. So hopefully one or two of those will start to listen to the Sherman Show, and we can get our viewership up to about 100 or so after that. But just seeing those statistics and everything. So first of all, how do you do it? How do you do it every single day, putting out such great content?
Well, thank you, Jeff. The honest truth is I've got a team, but I'm writing it every day to some degree. But I have a team that help me pick out the right stories and that make sure we don't miss anything. It is a little bit antisocial. I go to bed very early, and I do a bit of work from bed in the evening, and I get up very, very early. And actually, something that I haven't told many people, I finish it off just before 5 o'clock in the morning on my Watt bike. So I try to kill two birds with one stone, keeping fit and writing research at the same time.
Yeah, I mean, that's a jack of all trades, right? I mean, putting in that, maybe that helps with the, this work remote environment. At least I assume that's not the Deutsche Bank headquarters you're broadcasting from today. So those of you that want to know what I'm talking about, you can see this on YouTube at youtube.com/DoubleLine Capital. You can see the video here. But I assume that you're still working remotely there, Jim, given the background of the guitar and the painting.
I am, yes. I haven't actually been back to the office for 14 or 15 months. There are more people going back to the office, but I'm not yet back there. But I mean, it's interesting working from home because given that I've always done a daily that goes out before 6:45 in London time, for most of the last 15 so years, I've done a large proportion of my work from home because I couldn't physically do it otherwise. So I've always had a 2 or 3 hours a day where I'm working from home. So this is actually not too new for me, although the longevity of it probably is.
Yeah, you were the inventor of the hybrid work model before we all knew about it, right?
Maybe I was. Yeah, I couldn't persuade people at the time it was a good thing. So people didn't think it was a particularly productive way of working, but I think they're learning that it does have a place.
All right, so let's get into some of your research though too. You guys have been very vocal about the inflation debate, and I think what's very interesting is the research you guys are putting out is that you're putting out both sides of the equation: the transitory view, the permanent view, or the higher level over time. So first of all, let's just start with it. What is driving inflation today, and how are you thinking about it from your seat?
Yeah, well, let me take a step back. I've been at Deutsche Research now nearly 17 years, and I've never seen an issue that's divided us as much as inflation. The economists mostly believe that it's a transitory feature, and I think it's probably because they're looking at the bottoms-up numbers in minute detail, and when they look at the bottoms-up numbers, it's quite clear that a lot of the areas that to do with the pandemic are seeing quite big price rises, and there is only a little bit of evidence it's seeping through into other areas. So as an economist, I can easily see how the bottoms up tells you that this is transitory. There is also a few of us at Deutsche Bank who think that there's a structural change going on. And that is a little bit more difficult to model. It's a little bit more difficult to get out of a spreadsheet, but believe that there's a structural change going on. This now is the most coordinated monetary and fiscal policy has been in history, really, and it dwarfs anything seen in the financial crisis. It dwarfs anything seen in the Depression, and I think the economic orthodoxy is changing. If you humour me, let me go back 40 years. If I go back 40 years, Volcker was appointed at the Fed at the end of 1979 as an inflation hawk. The US wanted to get inflation down. Very soon after, Reagan was elected, and Reagan had a popular mandate to reduce the size of government. Now, whether he succeeded all the way through is a moot point, but his mandate was to reduce the size of government. That was an ideology that there was behind that. If you fast forward 40 years, look at where we are today. The Fed has come off Jackson Hole last year with a kind of a mandate to let inflation run a bit hot and to actually not lean against economic overheating, but to allow it to get to a point where they're happy with where the economy is. So they're not going to go on forecast gains, they're going to go on actual gains. And at the same time, Biden was elected almost to put government right at the heart of the economy. And since he's been elected, he's put government bang center at the heart of the economy. So I like that contrast between the Reagan Volcker axis and the kind of Biden Powell axis. And one last thing I'll say is that even on a shorter term basis, the economic orthodoxy, I think, is changing in the sense, if you go back to the financial crisis a decade ago, we very quickly ran into the Greek sovereign crisis, the peripheral crisis, and Reinhardt and Rogoff did their seminal work on levels of debt, which are massively problematic. And at the time, everybody was panicking about sovereign default risk, and therefore governments were desperate to consolidate their fiscal balance sheets and go towards austerity. And I think that kind of economic orthodoxy that was around after the financial crisis was showing some cracks before the pandemic, but it wasn't until the pandemic came and we've now got debt levels far above where they were after the financial crisis that I think we now have an economic orthodoxy that is quite tolerant towards both high government spending and money printing. So this is why I think the kind of in the background, economic orthodoxy is changing. And that's probably why economists aren't that quick to jump on it, because they're much more model-based. And I'm not sure you can necessarily see this yet in the models.
Yeah, no, that's a great point. And so when you think about this orthodoxy, and I think back to the global financial crisis that you mentioned, how QE was a temporary or an extraordinary measure to take place. And we know there's nothing more permanent than a temporary government program, right? That's the old joke. But if you think about it too, a lot of folks think that the orthodoxy hasn't changed to more fiscal stimulus. It is also transitory, and potentially that's what is leading people to think about this transitory inflation. And I like that you brought out of the Reinhardt and Rogoff piece as well, where I think it was like 70% starts to cripple, debt to GDP ratio, like 90%, you're just massively out of luck for the rest of your life until you default. And here we are with hundreds of percents and growing. So when you talk about the orthodoxy, do you think this is a new orthodoxy for this fiscal side, and just understanding that, look, we have these unlimited spending powers as long as we can print in currencies that are out there? How are you thinking about that as it relates to both inflation and as well as just overall global growth?
Yeah, well, I think as a society, we are less inclined to want to take risk, economic risk. And I wonder whether one of the legacies of the pandemic is that if we ever do have a recession again, how quickly it will be to people to say we should be doing furlough schemes rather than just basic unemployment benefit. And I think we've kind of institutionalized high spending. And the populism of the last decade as well was a bit of a rebellion against governments being relatively fiscally tight. And I think governments now realise that they're going to struggle to get re-elected unless they're offering a spending really to their population. So I think that the higher fiscal spending is getting more and more institutionalised, and I think ESG will probably institutionalize it further, and we can chat about that probably at some point as well. So my answer is yes, I think it is a little bit more permanent. I suppose there are risks, like the midterms in the US is a risk. But I mean, I think a lot of spending is going to be in the system in the next 18 months before we even get there, but it's probably a longer term risk. All I would say to that is that even under CBO projections of where the deficit was before the Biden tax stimulus package earlier this year, deficits were already going to be 4, 5, 6% for the rest of our lives as a minimum. So it doesn't feel like we're ever going to go to austerity. It's just how much the trough is in fiscal spending.
Yeah, the austerity is the derivative of the rate of change of that deficit, right?
Yeah.
But it is a structural deficit. So you mentioned something interesting there too about managing, I'll summarize as economic volatility, right? So have we now went to the world where we will not tolerate the boom bust cycles? And I know you guys have written a piece about the boom bust cycles, and will it transition back to that by having more inflation, having to be fiscal hawks, or I'm sorry, monetary hawks, and raising interest rates? But as you think about it, has something changed there structurally as well?
Yeah, well, I've done some work looking at the length of economic cycles in the US, and since the data was collected, I think, since the economic cycles have been monitored in the US, I think it's 170 years, there's been 34 cycles, I think. Of the 11 longest cycles, 9 have occurred in the last 50, 60 years when deficit financing has been a thing, if that makes sense. So before the last 50, 60 years, the only time government in the US ever had a deficit was during the war or the depression, or where you broke from the gold standard effectively. So virtually all the time you ran a balanced budget pretty much. But then once we got into the kind of spending pressures of the late 60s, and then we abandoned the gold linked system in 71 and moved to a fiat currency, we basically had deficit financing as an option. And at the start of that period, debt was pretty low. But the way we've elongated economic cycles and avoided kind of boom bust or whatever is every time the economy looks a bit tired, we just we spend a little bit more money, and structurally we're spending more money in the economy, which has made cycles longer, made us feel better, but at the end of it, it's left us with more debt than we've ever had in peacetime. So boom bust has kind of been eliminated, but at the expense of runaway levels of debt.
Okay, so does the debt matter? I mean, this is one thing that you harken back to Reagan, and it was deficits don't matter. I think I like to bring out that at the time it was George H.W. Bush that was running against him, said voodoo economics, right? This idea that we can borrow our way to prosperity. So does the debt matter? Reinhardt and Rogoff says it did. People think of it as a household balance sheet. It does, right? But when you're a government and a sovereign entity, does it matter as much? And what does the market think about it?
Well, I think obviously, if you adjust debt, taking out what central banks hold, debt levels are high, but they're not extraordinarily high. So I suppose the question should be, does it matter if central banks hold an enormous amount of your debt? And ultimately, it might come down to inflation and what the free market holders of debt do at that point. I would say it matters less if you've got a system that is heavily financially repressed, so you're forcing banks to own stuff against their will, other long-term institutions to hold it against their will, and you've got a central bank that has a bottomless pit. The honest truth is we've never been in debt levels like this in a fiat money system where central banks can create as much money as they can. So none of us kind of know, does debt matter? If we weren't in a fiat currency regime, debt 100% matters. There is no escaping it. In a fiat currency regime where you can print money, we don't know is the answer.
Okay. Well, I mean, that's why we like you, Jim. It's your honesty and fresh takes on things. Not saying that.
I suspect it does matter, but it could be a little bit further down the road than we expect, and maybe inflation will come to erode the value of the debt while we think about the answer.
Right, and potentially it comes down to servicing, right? But I think you brought up a good point here, talking about central banks owning a lot of the debt, and we see this with the Fed now leading the charge here with a $7 trillion balance sheet. I think we just hit that milestone, so kudos out there. But the thing is that when you think about the float of treasuries, as you mentioned, it's reducing it, and we've seen pressures on funding spreads, at the very front end of the curve. You've seen banks, really struggling with money market funds and the like, and hence using reverse repo and the facility or the repo facilities at the Fed. But outside of all that wonky stuff and really thinking about the details there, I mean, what happens with the Fed? Can they actually get out of this? We saw this in 2018 with Jerome Powell's automatic pilot and the thing. So is the Fed, let's just focus on them as one of the central banks, are they stuck forever holding this significant balance sheet? Because we saw last time with the unwinds, it did become a little bit problematic.
Look, I've had a long-standing view that central banks will be buying government bonds for the rest of my career. And unfortunately, I've got a decent-sized mortgage, and I've got children that are just starting school, so I've got a long time to try to earn money to rescue myself. So I think throughout that period, central banks are going to be buying government bonds, because if you look at any projection for any country, and the US is no different, debt goes up over time because of demographics, because of current assumed tax law, etc. And therefore, I can't understand this. I can't contemplate a scenario where the free market is going to be able to absorb that extra debt on its own without massive help in hand from someone. And that the biggest part of that is central banks, alongside, as I say, financial repression. So yes, I mean, the Fed will at some point taper from this current program because the economy does have some critical mass. But it might not be very long before they have to buy again. A bit like what we saw in the last decade. Every time we ended QE, the Fed was convinced that was it, or was pretty much on the way to being it. And we've had I lose count how many iterations now. Are we 4 or 5 iterations of what we're doing? Maybe a bit more if you break down some of the subcomponents. So yeah, I think it's with us for the rest of our career, really.
Yeah. Well, on that note, as you think about it, and really digging into the details too, like how do you get other people to buy treasuries? When you see the inflation headline prints where they are, you look at break-even spreads, they're implying that there's a pretty significant negative real yield, so a return after inflation there. I mean, do we just need to do what Japan did like in the 80s and go with a new marketing campaign? Maybe it's a little too sexist this time, but it's like real men buy JGBs, right? There was that old saying out there. But how do we change that? And I think that really it comes down to the idea, if we're going to have this inflation level, why would investors want to accept eroding their purchasing power? So that leads me to my question here: why does the Fed want inflation?
Well, I don't think the Fed necessarily does want inflation. I think it wants, it wants this kind of happy medium between having enough inflation that it just encourages that kind of animal spirits that maybe has been missing, and makes people, makes companies want to do capex, or makes investors want to invest in the real economy, but not enough that it needs to tighten policy. And it's a very narrow tightrope they're walking. So I don't think they particularly do want inflation, but they want to make sure the economy is going gangbusters. And I think they feel that because it's transitory, they can let the economy go gangbusters without any inflationary consequence. So they're hoping that they're getting the best of both worlds, really.
Yeah, that's Jim, that's an interesting point. One of the things I've been thinking about also, and just to kind of shift away from fiscal and monetary policy over to, perhaps the consumer side. But one of the big questions I think in this period right now is that we're trying to figure out who has ultimately the pricing power. Is it sit and reside within the producers, or is it ultimately going to get passed on to the price inflation going to get passed on to the consumer side of things? And overall, I suppose, what we've been seeing in the data is that input prices have been on the rise. We're seeing this anywhere from the PPI numbers through some of the manufacturing survey numbers. But at some point, it seems like there will be a tipping point as to how much the producers can absorb. At what point do you think this is going to shift over, or if it does, over to the consumer side of things?
Yeah, well, I mean, clearly you have seen that passed on. I mean, I suppose where it's been passed on most is construction costs around the world are going up. I appreciate that doesn't cover a wide range of the population, but food prices are going up everywhere. Obviously, petrol prices are going up. I think other kind of non-essential goods are perhaps, the companies are, having to absorb some of that in their margins, but maybe the acid test does this go into wages? I think as soon as there's strong evidence that it goes into wages, then it is a bit of a free-for-all in terms of price rises, because the consumer has a bit more pricing power to be able to buy higher prices, etc. And that's something that we're looking at. I think the anecdotal evidence is that there are wage pressures. But again, are they transitory? Are they just in the short term while we adjust to the obvious supply problems of the pandemic, or are they going to be a bit more permanent? I side on they will be a bit more permanent. Wages are sticky. Once they go up, it's very difficult to cut them. And the politics as well. The politics has moved on quite a lot in the last few years towards ESG, towards minimum wages, towards a fair living wage, and that I think does reinforce the message a little bit. So I think there will be a bit of wage pressures coming through, and that will allow prices to kind of be a bit more self-reinforcing.
So Jim, is it wage pressure from the competitive free market, or is it wage pressure from essentially government subsidies?
I think a bit of everything. I mean, it's quite clear at the moment the labour market is quite bipolar in some sense, in the sense that the payrolls are obviously showing that there's 7 or 8 million US jobs to get back before you get to pre-COVID levels. But the JOLTS data is very strong. The quits rate is very strong in the US, which people don't quit their jobs unless they're pretty confident about the labour market. So I think there's already a sign that the labour market is pretty competitive, and part of the reason is because unemployment benefits have reduced the incentive to find work. Obviously, COVID is also causing a problem as well, and therefore companies are having to lift wages to persuade people to get back into work. And as I say, it's not something that you can pay someone up for 3 months and then cut their wages. Once you pay someone up for the job, that is their kind of contractual pay. So I suppose the longer this period goes on, and ironically, maybe the longer the COVID disruption lasts, the more this inflation might be embedded, really.
Yeah, and I do agree with that, with the statement that the wages are sticky. And one of the things that we think about too is when we think about price increases, especially right now where it's most needed at probably the lower end wages. If someone on the lower wage scale gets paid a little bit higher based on a raise, that needs to trickle up as well, because people who are immediately above them in pay might want to raise as well. But one interesting fact is that I just spent the weekend and drove from Los Angeles, California, out here to Madison, Wisconsin to visit my mother, and I drove through much of America's heartland. And I recall just standing there waiting for my pickup truck to get filled up with gas as I was, I just set it and forget it. And I was sitting there taking a look around, and there was a Wendy's, just next door to the gas station I was at, and I saw now hiring. And this is in Missouri, the state of Missouri, which I think just took off, or it's about to sunset its extended unemployment benefits from the courtesy of the federal government. But the Wendy's was looking to hire people at what I thought might be an elevated, wage at around $13 an hour at the local Wendy's. And then I looked over at the gas station I was at, and they also had their sign up trying to compete. And their sign on the billboard said they're looking for $15 an hour for this gas station. So, definitely seeing some signs there. And whether or not it's going to make its way across remains to be seen. But I do have a suspicion that it probably will. But one thing I did want to, aside from that note, one thing I did want to touch on, and you mentioned it, is ESG and perhaps some of the inflationary pressures that we might see out of that. And and just looking around at in commodity market, one thing that we've been talking about is carbon neutrality and the goals across various economies for that. And I saw that around 9 out of 10 of the largest economies here in the world have all signed on to this carbon neutrality agreement by the year 2050. So all of that's going to require some additional fiscal spending as well to get various infrastructure grids up to speed in order to handle that. But what are your thoughts around just overall the ESG sentiment and how that could stoke some inflationary pressures as well over the long term?
Yeah, well, it's amazing to think how quickly this debate has moved, really, because I mean we've in my team, in the Thematic team, we've been kind of doing ESG research for a few years now, but it's been a struggle to really capture the imagination of people. So the graph was growing up, but it wasn't mainstream. So the rate of change in the ESG progress was high, but it wasn't getting critical mass. But something has happened in the pandemic to really push it front and center. Whether just people want to reset, rebuild in a different way is unclear, but it's definitely got a momentum now that is a steamroller, really. And Biden's election probably removed one obstacle. Obviously, the Trump administration was not sympathetic to the ESG movement, and obviously the Biden administration is sympathetic. So now you've got the US that is catching up with perhaps where Europe was, and fairly rapidly. So, and look at the oil industry. Between 2010 and 2015, the shale industry was gangbusters, really, it got to a point where I think in 2013, 2014, OPEC had to respond by flooding the market with its own oil, and trying to get back some market share, and the oil price just collapsed. And actually, linking that back to the inflation debate, we think one of the main reasons bond yields and inflation expectations were so low in the latter half of the last decade was because of this price war. And because of shale. And if you look at inflation expectations versus the price of oil, it is very well correlated. And I think what we're doing now is we've repriced the kind of, for want of a better technical phrase, we've repriced the kind of cost of mining oil. Shale energy is a bit persona non grata now. I mean, obviously Biden is reinforcing that. It is going to be more expensive to get energy out of the ground, and then alongside that, you've got the massive movement towards electric vehicles. I mean, if you go back to just before the pandemic, electric vehicles were a nice thing to have, and Tesla was a trendy company, but I don't really think it had critical mass. Now every car company around the world is desperate to tell their stakeholders about their funky product offering that's going to roll out very, very soon. And there's going to be a whole host of pressure on all of the commodities that go into producing an electric car that are slightly different from a normal car. And I think that is an element to this ESG story as well, as is the pricing of the externalities of growth. So for me, it points to a higher cost of doing business everywhere, really. And I haven't really thought through all the ramifications of this, but I think as a minimum, we're having to price energy use a lot more sympathetically to the environment than we did even 2 years ago.
Yeah, I think it's interesting you bring that part up too, because I want to talk about now putting on your hat as a strategist and thinking about this. So far, the ideas you're throwing out are talking about higher input costs, higher labor costs, the need for these certain commodities to kind of change the infrastructure, because again, if we're all going to have electric cars, we need to build that across the superhighways we have here in the US, and not the information superhighway, but the interstate system. And so when you think about all this, what is one to do when trying to position a portfolio for this? Is that, there's a lot of assumptions about correlations and different regimes. And so if there is this push on a structurally higher inflation number, and I'm not going to call it stagflation at this stage, I'll let you give us your opinion there. But how does one think about position this? Do bonds work in a portfolio still? How do you think about that for your equity risk? Do we need to be doing alternatives? How are you thinking about building portfolios to kind of capture this change and this structural viewpoint you have?
Yeah, I mean, I think the one thing I would say is that the authorities are still very, very reluctant to see a proper free market capitalist default cycle. At every point in the last 25 years, when we've looked like we're on the precipice, the authorities have increasingly intervened, and it's got to a point now where if they didn't, we've got so much systemically important debt that it would be counterproductive. So I have a kind of a prior in my kind of investment analysis that I'm happy to take default risk in aggregate. I think you're generally overpaid for default risk. So you can buy kind of a liquid credit. Obviously you have to be diversified, but I think you're getting paid to take default risk because the authorities are on your side. So rather than buying low yielding government bonds, I would be happier buying kind of more liquid credit positions and trying to hedge the interest rate risk out, which I don't like. Equities, look, a lot depends on real yields, I think, for equities. And maybe a lot depends on real yields for everything. If we lose control of real yields, given how the high debt is, it's game over for a lot of assets. But I suspect, as I said, with the Fed buying for the rest of my career, I think real yields will stay pretty negative. And that probably means that equities are not going to be as negatively hit as they were in the 1970s with inflation, when real yields were very, very high. I still think it will be a bit of an uphill struggle for equities in an inflationary world, but the fact that earnings are going to go up because of inflation means that it'll be a bit of a push-pull. Inflation will cause multiples to go down a bit, but then earnings will come up, and you get that. You probably will get a sector rotation. So personally, I think tech is overvalued if you think inflation is coming, and some of the cyclical sectors are perhaps well, some of the smaller value stocks and maybe cyclical sectors are probably going to have a bit more of a following wind to help them. I suppose commodities, look, when I do my long-term analysis on commodity returns, they're not a very good inflation hedge. They tend to underperform over the long run, but I think in pockets of inflation, they absolutely are part of your portfolio. So I think we're in a short period of time where commodities are a pretty attractive asset class, really.
Yeah, what we found is that it has a pretty poor correlation to inflation just because of the noisiness of commodity prices, one. But it's that unexpected inflation, right? It's when the regime shift and those change that tends to be, and that's what we've seen over the last, really now, it's been about 12 months, right? That shift in expectations has changed, and they have been pretty good. So that continues to be a theme that we favor as well. I also like the rotation concept. But I like the idea of hedging out some of the interest rate risk. One thing we do is we just focus on shorter duration assets. There's other parts of the market you can do that without getting too complex there. But when you think about the Fed and its intervention, we have a big meeting that starts today. At the Clays building. I'm probably not saying that right. But what is the Fed? What is your expectations for the Fed and their announcement tomorrow? There's a lot of people thinking about tapering and the Fed kind of removing a little bit of support. I hear what I think is a pretty a weak argument is that they should stop buying mortgages because look at the housing market. I don't really think that them buying mortgages, that they need to buy interest rate sensitive assets to keep interest rates down. I don't think it's really mortgages, but again, I'm leading the witness here. So let me shut up and ask you, what do you think what's in the Fed's cards? What do you think taper looks like? When does it happen? Is it announced tomorrow, later on? What's your view?
It's probably going to be, I'd like to give your readers a really interesting soundbite here, but I suspect it will be a relatively dull.
Well, by the way, Jim, this is going to come out after the Fed meeting, so you're going to be in the hot seat.
Oh dear. Right. Well, I think the Fed will probably be relatively dull and give us a few little signals, a signpost to what they will look to meet as their criteria for for doing tapering. I mean, although I'm an inflationist, you could look at the inflation numbers that we've seen so far, which, to be fair, were well above any of the non-inflationist forecasts. But you could look at it and say, yes, but it is transitory still. So there's enough in the data that if I was inclined to want to be dovish, I could be. And the Fed are, have made it quite clear in the last couple of months that they are leaning on the dovish side. So there's enough in it for them to give it another meeting before they have to be too hawkish. So I think tomorrow is a kind of or yesterday when this comes out is another step in the kind of thinking about. So they will give us some signposts, but nothing too concrete. I suppose for us, we're looking at the dots. That's a minor thing for the market. Will the median dot for 2023 now show a rate hike? I think we need 2 Fed governors to move from 7 to 9 to make that a medium. It will give the market a little bit of excitement, but it's probably not the biggest thing in the world from a structural standpoint.
Right. And on that point too, I mean, I've been kind of in the camp for the last few months that they probably wait till Jackson Hole as the place where they really start to really tweak the policy. Because if you think about it, that's when they announced, their new inflation targeting. It seems to be just one of those symposiums where they want to make it relevant, and that's just an extra kind of Fed meeting that we get where it's more policy driven and you get in the inner working. So, even if the Fed does announce some sort of tapering, I think the key here is signaling, right? That's the difference. We don't want to have another tantrum. It's that forward guidance. And so I guess the question becomes is the Fed almighty too? I mean, is it just that they can control interest rates? We've seen the largest inflation prints that some people have seen in their careers, going back 20 years in some instances. But when you look at it, the bond market rallied. So is this a short covering? Is it the technical side of it? Do you think that there were some issues there? Or do you think the bond market truly feels that this is transitory, we have the structural deflation, or is it just, kind of technical positioning for the time being?
I think in terms of the bond market is probably a little bit of everything. I mean, we've tried to spend a bit of time over the last few days working out what the reason for the bond market rally is. I mean, I think a poor excuse for it is the week of non-farm payrolls, but it is an excuse. So to be fair, the Fed have targeted that to some degree, so it's understandable if the market follows them. But other measures of the labour force are very strong, so I think that's probably a little bit of a weak excuse. We can't forget international things. I mean, a month or two ago when treasuries were around about their peak for the year, we were wondering whether the ECB would taper in June. And I think as May developed, it became quite obvious that they weren't ready to do that yet. And that probably injected a number of basis points of the rally, being a global force. China, I mean, the credit impulse in China has rolled over a little bit, and people have looked at hard metals that have rolled over a little bit. Again, I would say there's no evidence of that in the oil price, but China in industrial metals kind of peaked out at the same time as treasuries. Obviously, the infrastructure package has not really progressed too much, and that maybe has kind of dampened some of the overspending fears. And also there is a technical reason. We perhaps could have been a bit better in understanding this beforehand, but the Treasury have a balance at the Fed, and it looks like from the data that the Treasury overissued last year. So coming into this year, the Treasury had a big balance at the Fed, bigger than they've ever had before. Actually, it's gone up probably a $1.5 trillion. In the preceding 9 months. And when the Biden fiscal package came through, instead of issuing lots of bonds, they ran down that balance. And when you run down that balance, effectively what you're doing is putting deposits into the banking system because it can't all be spent. And I think the banks have been left with this excess liquidity that then they've rotated into treasuries. Now that seems to have normalized to some degree, so I don't think that's going to be as big a force going forward. But I think undoubtedly banks have bought a hell of a lot of bonds in the last 3 months, and I can't help thinking one of the reasons is that the Fed chose to run down its balance rather than issue new bills.
Yeah, our agency mortgage guys have been really, really talking about that too. The bank bid has just been insatiable there.
Yeah.
So.
Yeah. And so Jim, appreciate your time on all this, and we've kind of corralled you to just fiscal and monetary policy and the side effects of that, largely inflation. But just wanted to see, before we let you go, if there's any other things that are top of mind outside of that scope, perhaps a distant second to inflation and some of the stuff that we've talked about that our listeners should be focusing on.
Well, I think at some point we've probably got to work out what the steady state of the world is in terms of growth and productivity. And I suppose we went into the pandemic with a lot of problems, and will we be able to cure those problems? Are we resetting things in a way, or will we just go back to kind of the problems we had before the pandemic? So that's kind of front of mind. I don't think we're quite. I think we still got a few quarters of pretty strong growth, but it'd be interesting to see at what time people start to price some of the structural problems of low productivity, high debt. Well, obviously that's people don't care about that at the moment, but these are all topics we were talking about before the pandemic. Look, maybe an investment boom because of ESG or infrastructure has the ability to start to change some of this. But if infrastructure goes by the wayside globally, then maybe we've just had a massive consumption and reopening boom, and we'll go back to low productivity, low growth, possibly with higher inflation, but we'll see. So I suppose that where we are long term, what our steady state is certainly a fascinating topic for me. I mean, other things that I think are fascinating is geopolitics. I mean, if you go back, I'm going to say 3.5, 4 years now, most governments around the world were still caught in the relationship with China, perhaps more so in Europe than in the US. But obviously, the previous president decided to make that US-China relationship, a much more contested thing. And within 3 years, really, a lot of the developed world are at some degree of loggerheads with China on certain measures. So, if I fast forward 3 years, where is that relationship going to be? Is it going to go back to normal, or is it going to deteriorate at the same rate it's done in the last 3 years? If it deteriorates at the same rate as it's done in the last 3 years, that has it has massive implications for the kind of setup of the global economy that we've known through our career, where China has been integrating more and more and more. So that is probably a big, 0 to 3 year thing on my mind as well.
Yeah, I think what you really highlight there too is just the challenges with the current environment. And I think this is, I know from my own experience, this is what makes the investing business fun. It's the problem solving, and it's getting great minds together to have intellectual debates. And as you said with the Fed, we can take the data and splice it how we like, but ultimately, the data is going to tell the story. So, Jim, we thank you for your time today. It's been a pleasure. It's great to see you again. Thanks for taking the time out. But, one thing that we need to do is make sure that our listeners can have a way to access you. So what's the best way to get access to the work you put out and follow Jim Reid's current thoughts?
Well, you can email me at my Deutsche Bank address. If you are a client of Deutsche Bank, I can easily add you. Otherwise, it might be more difficult. But you can see me on Twitter as well. I occasionally post public stuff, so I am on Twitter as well. At Jim Reid 35 is my Twitter handle.
Okay, 35. We'll get into that a little bit later. So, Jim, thanks again for the time. But before you leave, I'd be remiss if I didn't introduce you to Sam's favorite part of the show. So, Sam?
Yeah, and Jim, that favorite part of the show is called Sherman Says. That's where I'll offer a series of alternating prompts between you and Jeff Sherman to elicit top-of-mind responses. So I'll begin with the first prompt to Jeff Sherman, and that's transitory.
Temporal. That is what time will show us.
Over to you, Jim, with working age population.
Shrinking.
Accumulated savings.
Pent up.
Inflation protection.
Expensive.
All-time high.
More to come.
U.S. hegemony.
Glad he gave that one to you.
No comment.
Fed independence.
Waning.
Return to office.
Hybrid.
San Francisco Giants 2021.
Best team in baseball. Check the standings.
All right, and then the last one to close us out here, Jim. It's going to be a statement first by me, and then followed by the question. So, happy belated birthday, first of all, and then the follow-up there is, what did you get for your birthday?
Well, there is a question.
If you could say it.
There is a question. My wife is usually pretty good about buying me presents, and it became quite clear in the run-up to my birthday that she hadn't done anything, and I just wanted to preempt any boring, rubbish, pointless present. I said, I've got an idea. I am obsessed with golf. I'm probably the most obsessed person you could ever meet about golf. I said, why don't I go into my local pro shop, spend a large amount of money and split all the presents I buy between you and the 3 kids I've got. And we came to an agreement. I did that. I was deliriously happy. The kids had something to wrap, and it's a model for all my future birthdays, I think, from now on.
That's awesome. Yeah. I mean, if you're going to get the stimulus in a gift form, you might as well ask for the one you want, right?
Yeah.
Yeah, absolutely.
I was very, very happy. If this happened every time, I wouldn't be too upset.
All right. Well, let's wish you well for next year. We'll have to get the 2022 update. We'll bring you back on the show to find out how that's working, as well as some of our discussion points today. So again, Jim Reid from Deutsche Bank. Again, number one strategist out there. Very, very great research. So if you're a Deutsche Bank client, make sure you reach out to him. If you're not, maybe you should become one as well, so you can get access to the great minds like Jim at DB. So thanks again to Jim. For those of you that want to catch this on a podcast format, we have the iTunes, the SoundCloud, the Google Play. You can follow us on the Twitter. Our handle is @ShermanShowPod. We also have another podcast that Sam Lau co-hosts. He's got a lot of time. He's a busy man these days with Jeff Mayberry, where they do Monday Morning Minutes. That's a weekly podcast where they cover everything macro and markets. So check that out. What's the handle on that one, Sam?
For the Twitter, it's @DLine Minutes. I gotta start learning how to use this Twitter stuff. So I think it's @DLine Minutes is the proper way to say it.
So what's funny about that is Sam's admitting that he doesn't post the stuff on Twitter right now. We have someone that does that. So anyway, it's great content. We're getting a lot more followers there. I encourage everyone to listen to that for the opening bell on Monday morning every week. So Jim, once again, thank you to all the time you spent. Thanks for commuting with us today. We appreciate it from all the way across the pond, and look forward to our next discussion. Stay tuned for more Sherman shows coming soon as we start the new season. We got plenty of guests coming. That are the quality of Jim Reid and the like. So thanks again, Jim.
Thank you very much. Have a good day, everyone. Thank you.
Thank you.